What's going on, guys? It's Dan from Pekoe Mortgages, and today we got something really cool. We are calling it Tuesday Talks. It's a podcast format video series that we'll be doing every Tuesday. Now, I say we because I've got a co-host. His name is Harris Zulkernan of Treadstone Law. He's a very good friend of mine. He'll be joining me along with some other guests throughout the weeks. So today it was just him and I were talking about interest rates and answering some questions there, and that's really what we're doing, is answering questions and bringing on some informative guests. So I hope you guys like it. Let me know what you think in the comments below, and you can expect to see them every Tuesday. So again, we're calling it Tuesday Talks, and we'll get into the first one right now. This is our first podcast together, so it's kind of exciting. I get to virtually sit down with you and we can chat a little bit. And I think the format being kind of informal, but just kind of speaking what's on our mind, and it'll make for good conversation.
Yep. And for context, for the people watching this podcast for the first time, okay, I'm a real estate lawyer in Ontario, and Dan's a mortgage broker, so we're very kind of involved in the day-to-day of real estate in I would say Ontario and in Canada as well. Canada, we always have an eye in what's happening in the States as well, so I don't think we're kind of local.
Yeah, it definitely wouldn't be considered local, because you're right. Like, everything we do is, there's an effect on a larger scale, and we see it here at home. But yeah, I'm excited to kind of get talking a little bit about things that have been on my mind and things that we talk about, when the cameras aren't rolling. So
I mean, we talk about this every day, so we kind of have routine calls, like trying to figure out what's going on in the market, because it's difficult for obviously one person to understand everything, and there's a lot of information being thrown at you, and that's kind of what we wanted to talk about today. Figure out, like, based on what's happened past 2 years, we've been in lockdown. And as a result, there's been just certain monetary policies, certain financial or fiscal policies by governments, not just in Canada, around the world, that are influencing real estate. I think a lot of people are kind of confused as to whether now is a good time to buy or not.
right.
Especially like in Ontario. I mean, we had like some record increase in prices. It was like
Oh,
insane
dude,
last
it's
year.
been crazy. Yeah, it's been pretty ridiculous. And you're right, with the lockdown, we saw a little bit of, you know, they say a correction, when people couldn't even get in to do home inspections. They couldn't get in to do open houses, and people were starting to panic. So there was a little bit of a sell-off, but it's come back in full force. And this is a great format for us to kind of talk about what's happening, what's
Yeah.
caused it maybe, and where things might be headed.
I mean, what's when you say sell off? Was there a dip in prices?
Yeah. So there was a point, I think it was early 2020. So probably we're talking like late Q1, early
Mm.
Q2, where there was a point where a lot of people were just kind of doing the wait and see approach. They weren't sure, they weren't giving up their houses. Maybe they had plans that they were going to upsize, but that involved them selling. So they were just kind of staying put. So it started to put a little bit of a choke on the supply. But then the stuff that was on the market, and especially condos, like we saw, there was a drop in rents. So people were kind of leaving, and condominiums weren't getting what they were getting before, and the demand just wasn't there. But I mean, that was short lived. And now that you look at it, I think it was kind of a delayed winter market, to be honest, because
Mm.
now it's come back in full swing. And yeah, we're dealing with a whole bunch of things, including this pandemic that just will not go away. So that's definitely been a factor and influence on the markets.
I mean, I think that for the most part, everybody's fed up with the pandemic.
Oh man, yeah.
It's like everybody's just done
Actually,
with it.
100%. I had a call with a client today, and she's like, I don't know what I did wrong. Like, she was internalizing it
Yeah.
because she, double vaxxed, and had her booster. And, it's still like, when are we going to get back to normal? And that's a whole, I mean, we could talk for hours on that.
Yeah.
that subject alone, but it's definitely having an effect on one, interest rates. So I'm seeing that across the board, and then two, just in the housing market in general.
But interest rates, like interest rates going up, interest rates going down. Like in what sense?
Yeah. Well, I mean, you've probably seen this too, because with the amount of purchases and refis that come across your desk, you probably noticed too that the interest rates that are showing up on these commitments a little bit higher than they were before, right? So we're seeing a few things going on. Bond market. So at the beginning of the year, it actually dipped, and we were sitting at and I don't memorize these here, so I had it
Uh,
up in front of me. But the Bank of Canada, the 5-year benchmark yield. So in the beginning of this year, like just January, we hit about 1.25, and the bond yield, the 5 year, is what sort of dictates the fixed rate market. So we saw people were saying, hey, interest rates are going to increase, and they did. And the last quarter of last year, the rates were starting to go up, and then they kind of petered off and stayed put. But from January, it was at 1.25, and just a couple of days ago, it closed at like 1.6. So we had a pretty good run up the entire month of January, which means interest rates, because of that spread, fixed rate mortgages are going up, and across the board they're like 3% now, which is crazy because you think about it, 3% for the cost of borrowing,
yeah.
still not too bad. But then we've got the variable rate mortgages that's making the headlines, and variable rates are, it's a different mechanism that controls the variable rate mortgages. And you're pretty knowledgeable on this, but the Canadian dollar overnight rate is one of those mechanisms,
Mm.
and we're at the lower boundary of 25 basis points, right? So everyone's like, oh, what's going to happen? Is the Bank of Canada going to make a rate announcement? In fact, this afternoon I was on a call with TD, and they came up with their economic report, and they're predicting about 3 interest rate hikes this year. So that would work out to 75 basis points. But even if we take that into consideration and we say, okay, variable rate mortgages are going to go up 0.75%, it's still a heck of a lot lower than your fixed rate counterpart, right? So right now it's like 1.5, maybe you can
Yeah.
get lower, like 1.25. It's pretty insane, man. So
Do you
yeah, that's
feel
kind of what's
though?
going
Do you feel that we're gonna increase 3 times? I feel like it's more posturing than anything else. Cause we were supposed to increase like a week or two ago, whenever last week, when both the Bank of Canada and the Federal Reserve for the states kind of met. Everybody's like, oh my God, they're going to increase it at least
on. Yeah,
25, probably 50 basis points because we're having runaway inflation.
yeah,
So, like, but they didn't.
yeah, yeah.
I feel like for
So
me, it's
yeah,
posturing.
yeah, it could be. It could be a bit of that, and definitely that was that was the talk of the town. I think it was last week where the Bank of Canada made that announcement. They're just going to kind of keep things as is for
Mm.
now, and again, revisit it on the next announcement. And I heard, some of the major banks economists were saying like 6 increases in 2022, but now we're going to see them at the second or end of the quarter, and it's like, okay,
Mm.
well, it may happen, it may not. What we know today is that the variable rate mortgages are a heck of a lot more um, uh, appealing
Yeah.
than fixed rates right now. Um, are we going to see those increases? I don't know. I think it's probably possible. We might see a few of them increase, but really, I don't even think that should be the determining factor in whether or not someone decides to go fixed or variable right now.
Mm.
Um, yeah.
What would
So,
you recommend, fixed or variable?
yeah, yeah, it's like that. Well, I mean, from just a purely sort of like, I guess, numbers perspective, right? You're looking at, let's say, 1.5% versus a 3%. What's lower? 1.5. Now, there's inherent risk with the variable rate because as the Bank of Canada makes those rate announcements and they start moving it up, your interest rate's going to go up. But if you kind of think about it too, um, you've got a 1.5% jump on a fixed rate as of today. That's
Mm.
6 interest rate hikes before you even get to today's fixed rate. So one of the recommendations here that I've seen some of my clients put into place is just like simply set your payments as if they were a fixed rate mortgage. right? If you're considering a fixed rate, you know what those fixed rates are going to be. You know what your monthly payment's going to be. Just
Yeah.
set it like that, because then you're just kind of self-insuring. It's kind of like,
Yeah.
for me, having a dog and having a cat and animals, you can either self-insure that animal, or you can pay that insane amount of insurance premium, um, and then maybe use it down the road. So that's sort of where I see things going. And then the other conversation to have is like penalties, right? Because you probably know fixed rate penalties are more expensive than your variable rate penalties, and it's just giving you a little bit more flexibility in that. But again, it depends on sort of the situation too. So clients that are like doing alternative um, mortgages, and for anyone out there that's listening to this, alternative mortgages are mortgages that are done by alternative lenders. So you've got this whole group of lenders that kind of cater to people that either have poor credit, maybe don't have credit, don't have reestablished credit, maybe the income's non-conventional, right? So self-employed, maybe newly employed, new to Canada, or maybe there's some issues with the house too. So alternative lenders step in, and most of the time they don't offer variable rates. So it's simply a fixed rate you have to choose. And it's just a term you got to choose.
Mm.
So in that case, like I can't go and say, oh yeah, I get a variable rate, because the variable rate's not available to that client.
Yeah, fair enough. But I feel
Yeah.
like my kind of prediction here is that I feel like the economy is not doing too well, right? But central banks have to kind of lead on to the fact that, like, hey, the economy is doing perfectly fine. It's not
Right.
that it's not doing too well. It's that you don't know. We're in COVID. There's economy shuts down and goes back on, off, on, off. They're like, what the heck's going on? But they also want consumer confidence. So they're going to say that, hey, it's strong enough for us to hike it 3-4 times, but it may not be. They don't know. In reality, but then they're also balancing their own credibility. So I'd say that it would go up maybe once, right? 25, maybe 50 basis points, but it's not going to hit like 1%, man. So I don't feel like we're at that position where Canadians or anybody in the world right now can handle that.
Yeah. Yeah, I agree. I think it would be too much of a shock. And, yeah, I don't think we're at that point. I mean, when Omicron started to hit the scene as the new and improved,
Yeah.
variant that was coming out, people were like, "Well, how's this gonna shake down in the economy?" And I was saying for a lot of people that were like, "Oh, we should just do fixed." Well, let's wait and see here, because chances are it's going to have an overall effect to the economy. And then you see things like, I don't know if did you I couldn't get a hold of you on the weekend. Were you over at that Freedom Convoy, or what were you doing? No.
No, it was just at
Yeah.
home.
Yeah, so you got like a whole bunch of ticked off truckers that are clogging the arteries,
Mm,
and heading across Canada here. That's going to obviously put some pressure on our supply chain too,
yeah,
and that's got to factor into things. I mean, there's a lot going on now that we weren't dealing with. Bring me back to 2019. That was a nice year.
it
I want to see
was.
that one again.
It
Yeah,
was. You know what? It's like I just remember Kobe Bryant dying, and everybody's like, "Oh my God, oh this and that," and then all of a sudden, COVID hits. Nobody knows what happened with him anymore. There was like a
yeah,
significant amount of
yeah,
time where everybody's kind of like, "Oh my God, this is an insane loss," and then as soon as COVID hits, it's not in anyone's kind of mind.
yeah,
It's not even in the news. The news kind of just flipped over to something else.
yeah,
But
yeah. It's kind of crazy. Like I remember back in February. So we moved into our place in February, and February was it was just a crazy month. And I think I told you we had gone to that Grant Cardone conference out in Vegas,
oh
and
yeah,
just going to Vegas and seeing like, on it was everywhere. It was all over the news, and it was one of those things where it just had an eerie feeling to it. Even when you would walk into grocery stores coming back in early March, you're just like, this doesn't seem like a normal sort of, virus that's going around. But I mean, here we are today, and yeah, it's definitely had its effect on real estate. That's for sure. Now, there's something called um, negative inflation. You want to talk to me about that? Because you sent me an interesting article.
yeah. Let me just put it on. Um, our little screen. 1 second. But yeah, I mean, I found this to be a pretty nice article. What this kind of tells me is that um, against all odds, we should be trying to buy a house.
Yeah, I mean that's kind of like one of the key takeaways here, right? Because um, getting into this article where they essentially explain that when you factor in for the cost of borrowing
Yeah.
that money, and then you net it with inflation, we're actually in negative interest rate territory. They had done some calculations. I think if you go, yeah, so real 5-year fixed mortgages have negative rates. So this was kind of cool. So
Mm.
both insured and uninsured, 2.23 and 2.36 mortgages in November. Yeah, and then they did some calculations too, just below that, where I think yeah, here we go. Never been this low. So they calculated when adjusted for inflation, real rates for insured negative 3.3 and
Yeah.
uninsured are absurdly low. I mean, that's kind of
So
crazy.
where does this? Where did it say? Did it say what inflation was? Hold on, let me just see. No, it's not going through inflation, but I know off the top of my head that December came in for us at 4.8%
There
inflation,
you go.
right?
Yeah.
Well, I mean, I could probably do the math here and figure it out, but it's like 2.5 plus 2.2 here. Yeah, they're roughly figuring around 5%. So 5%, um, uh, like inflation. And so I mean the concept for most people, and I don't know if people are familiar with it. Again, exactly what Dan said. If your inflation is 5%, it means that every year your money loses 5% in value. And in order for you to make any kind of money on any kind of loan, you need to make sure you make inflation and then a little bit, right? So typically, right, like in a normal market, it may be 5% plus whatever risk people feel there is in order for them to give you a mortgage. So it could be 3%. So it should be 5 plus 3, 8%. Right. So
Yeah.
that's where normal interest rates may be. But right now, it's like money is losing more value or losing value faster than the interest rate. So it's basically if you can get your hands on money, you should be getting your hands on money to buy real estate.
Right. Yeah, and that's and I think part of that is what's driving the market too, whether they know it or not. But there's a huge push to get into hard assets.
Yeah.
I think you mentioned about precious metals too. I mean, I don't really keep up on the precious metal game, but I know for a while everyone was talking about buying, silver and gold and other metals. Um,
I mean,
yeah,
so it's like the way I feel like the finance world works is for average, I would say for everybody, they kind of instinctively price everything out in the currency that they're kind of buying stuff, right? So for Canadians, that's the Canadian dollar, right? So you go out,
right,
a bag of milk is going to cost you $4, $5, whatever it is. So and then at home, the average home is going to cost you $500,000, a million, whatever it is, right? So when that price goes up, people are like, "Oh my God, the value of this house is going up." In reality, how they should be looking at it is the value of the cash I'm holding is going down because you
right.
have prices going up across the board. It's not just the houses, man. It's like food, everything's going up. Energy prices, everything is
Man, have you
going up.
tried to get an automobile lately? You
Yeah,
go into a dealership and they're just throwing on these insane price increases. So yeah, across the board, everything you buy is more expensive now, and I think people need to kind of take that into consideration for sure. Like, if you're at a job and you're not getting
the
a
raise.
raise that is outpacing inflation, then
Yeah,
you're in trouble because you're making less.
yeah.
So yeah, I mean it's definitely a tricky market, and but if you can get in, however, and that's why like one of the conversations here, we talked variable and fixed. Well, if you're doing like an alternative mortgage, and I shot a video. Hopefully, it comes out next week. Shameless plug. I do have a YouTube channel, so you can go follow me on Pekoe Mortgages. But so today's video, I was trying to come out with some strategies for first-time home buyers, right? And how they can kind of position themselves to get into the market, because it's really a seller's market, and it's a psychological game and psychological warfare. And if you can, kind of get some tools to help you out here, and one of those tools could possibly be being able to get gifted funds, or getting to a point where you can at least get 20% down. Because if you can get a 20% down payment, then you've got all these different tools in your tool belt that you can close. And yeah, you know what? The cost of borrowing might be a little bit more expensive, but we look at it and everything else is expensive. And if you can just get into the real estate market, we know that's, it's not predicted to go down anytime soon.
The people who, again, like going back to like just the value of money going down, I think the perspective is a little bit wrong. Like, let's turn this around. If I were to tell you your house is going to lose value, right? 5%, 10%, pick a number,
right,
every 6 months, what are you going to do? You're going to try to sell it.
Right? Yeah.
Are you going to be waiting for anything? Are you going to be like, okay, maybe I'm going to get a better price? Or are you going to be like, I need this out of my hands.
Just stop the bleeding. Yeah, let's liquidate it.
It's like either I lose or I lose more. So the same thing is when you're in cash, you're losing. It's not that the real estate price is going up. It's that your cash is losing value. So either you want to lose or you want to lose more. So it pushes you to go into hard assets like real estate, where you're stopping the bleeding. You're not really, the value of the house is not going up. The value of your cash is going down.
Right. Yeah. That's that's definitely a different perspective that, and a good way to kind of look at it, that I think some people need to kind of get their head around.
Yeah, because a lot of people I feel like are like, okay, I'm going to wait for the market to go down, the bubble's going to burst and stuff like that. I don't think it's going to burst. We're kind of past that point. Usually markets burst because the concept of quantitative easing wasn't something that was used. You had not to get too kind of technical, but you had somewhat of a like controlled money supply where you're not expanding it like this much, right? If you look at the States, the US dollar is a reserve currency. More than half of it was printed out in the last 12 months. Everything should be doubled, right? And that inflation doesn't just stay in the States because it's a reserve currency, is pushed out. It could be coming to Canada. It could go anywhere else because that currency is like something that like you can go and buy anything else with. And then especially the G8 countries, central banks, right? They will print together so that the parity is somewhat similar and it doesn't look too crazy for investors. So Canada has been going on a bond, like quantitative easing, bond buying spree as well. That like is not maybe as pronounced as the U.S. is, because it's not even that much, but it's still a lot compared to the size of the country, size of the economy.
Yeah. Didn't they just? I think they announced back in December that the quantitative easing, they seized it, or they stopped it as part of their monetary policy there.
I think they stopped it for good, I think, but then the thing is
they might bring that back.
They might bring it back. It doesn't, in the States, here's the ironic part. The Federal Reserve says that they're going to start contracting, right? But like when they're saying they're contracting, they're going to be buying less bonds on the market, which means technically you're just less loose. It's still a loose monetary policy. It's just you're less loose, all right? So you're not really contracting. You're still injecting. They're still injecting money into the economy that they're creating, but it's not at the same level as it was before. It's not like you're tightening up the monetary base. So like it's something that people I don't think we're going to get to a point. Here's the issue with the Federal Reserve too. It's like, if you bump it up 25 basis points, 50 basis points, I mean, the Treasury is going to go bankrupt. There's no money there. You're not going to be able to make your interest payments on your bonds.
Right.
So you have to make, and the interest rate can't go below 0%. I mean, we're technically below zero because it's monetized debt buying, but at the same time, like you can't go lower than this. So I feel like you can either print or print more. So I feel like inflation is here to stay. There is no transitory stuff.
Yeah.
It's just that you have to get into like hard assets, like whether it's a house, and if you don't have that, like again, like going to gold, it's like gold is not going up in value. The price of your cash is going down in value. Gold,
Right,
they're
right.
saying with the amount that's been printed out, it should be around like $10,000-$20,000 an ounce US. That's what the price should be based on what's been printed out, right? But
Right,
it's not.
right.
So it's a matter of time before it starts going up.
Yeah.
And there's a lot of people who kind of, there's Bitcoin and all this other stuff. Bitcoin is not going to replace gold. Bitcoin is a highly speculative asset, right? And it's like, for those who say it's not, it's crazy that you'd say it's not, because Bitcoin, the amount of just volatility it has in price, like gold doesn't have price. It doesn't like drop 20% in like a week and then try to go back up 100%. Like that volatility is not like, because you get into gold to preserve your value, so it's
Right,
not
right.
you can't preserve value in Bitcoin.
Yeah, yeah. And you're right. It's been pretty wildly swinging the last few weeks, man. I don't know if you've been keeping an eye on Bitcoin and Ethereum, but yeah, there's yeah, it's a whole different game if you want to get into that, and speculative, and there isn't that intrinsic value there. I was just kind of reading an article here, and you mentioned the inflation rate of 4.8%. And I'm seeing here Reuters saying that Canadian inflation hits a 30-year high. So I remember last year where there was a lot of talk of it being transient, and it's just, we're going to get over it. And I think you're right. It's here for the long haul. So how do we manage it, and how do we make our money um, work for us and not lose its value? And
Mm-hmm.
that's get it out the door,
Yeah.
and start buying stuff. So part of
Cash
that
is
is
trash.
cash is trash.
Yeah, that's what Ray Dalio is saying, right? And for those of you who don't know, Ray Dalio is the founder of Bridgewater, one of like the largest hedge funds in the world. The guy's worth like billions of dollars, self-made, probably in the top 20 or whatever. And he's going around, he's saying cash is trash. And so you have to get out, because that's like they're forcing you out. That's what the Federal Reserve, by printing it off, they want you out. So
Right. Yeah.
don't wait for the house price to go down. I would say if you can afford something now, get into it.
Yeah, and I mean, I would say I would speak to those first-time home buyers that think, okay, you know what, I'm not going to find anything in Toronto. Probably not. I mean, there was a report that came out yesterday that said the average condo price, and these are condos, and keep in mind, I lived in condos for a while. They're it's kind of fun to be on, top floor, 46th floor, whatever it is, downtown Toronto, but you're paying for what you get, and what you get is a very small footprint. So over $700,000 now, the average condo price in Toronto. Can you imagine that? But now, for some people that want to get into the real estate market, maybe they don't buy a property that they're living in. Maybe they just, they skip and they pass go. They collect their $100 and then they go directly and buy a rental property in another market that you can pretty much self-manage, because there are a lot of places within an hour or two from Toronto that are like way cheaper that you can get in, that the rents are solid, and like you said, preserving your wealth. So all of a sudden, you might have enough money to put down on that down payment. So yeah, man, I mean, it can be a discouraging market, but this is why it's so important to kind of like figure out where you're at today and come up with a game plan. And not to toot my own horn as a mortgage broker, but I mean, that's part of our job, is to just try and figure out for people what's the game plan, and how do we get you into a house. There's enough programs out there, and there's enough ways that if you want it to happen, you can make it happen.
And I think there's a lot of skeptics out there too. It's like, oh my God, for somebody working in the real estate industry, like you're trying to get people to buy real estate, right? You'd promote the industry. My thing, like, look at the technical, do a technical analysis yourself. Look at the quantitative measure. Like, we're not giving qualitative answers, we're giving quantitative answers, right? If you're saving money and every year 5% is being wiped out, right? You have to work 5% more, right? Meanwhile, prices keep going up, right? Not only, so you think that real estate prices are going up, let's say 20%. It's not 20%. Your value of your cash is going down 5%. So now you have to catch up another 25, right?
Right.
So you have to look at both sides. So you have to like move. It's not like you can park your money and then just be like, all right, that's fine, I'll keep saving, and then when I have enough, like, no, you have to figure out, okay, my money, I need to preserve wealth. I need to make sure that I have a certain value, like my money that I'm saving up is my wealth, and it doesn't kind of disappear overnight. And if it means that I have to, like you're saying, go somewhere outside to buy a rental property, why the heck not?
Right. Yeah, I agree with you. Yeah, it's definitely a challenging market, but I mean, what's the alternative, right? If you're trying to shop, like you said, if you're waiting around, man, I've heard this. Like for those of you that are tuning in, you can see Harris here's got a lot of cars on his desk, and Harris and I back in the day, we actually worked together in the automotive industry. So yeah, it was even back then. Some of the people that I worked with, so we were at different companies at one point, and people were talking about, you know what, we'll just wait until the market corrects. We're
Yeah.
talking like, this was like 14, 15 years
Yeah.
ago.
It's a
They were
long time
saying they're
ago.
just going to wait to
Yeah.
get into the market when it corrects because, that single family detached at $425,000 and, downtown Toronto was too expensive. Like, come on. Um,
Dude,
and who's
since then, I would argue that house prices have probably doubled. Okay.
right?
Dou-
Yeah, yeah.
have their salaries doubled?
That's exactly it. That's the big question. Um, And not only that, but then you have sort of like back in 2017, there was the B20 guidelines that were introduced with the stress test. So now all of a sudden, the people that, the middle class, the working class that are trying to get into home ownership, they got more hurdles they have to jump over. We've seen that stress test rate. So for those of you that don't really know too much about how you qualify someone for a mortgage, even though we're talking interest rates of like 1.5 to 3%, the Bank of Canada, or sorry, there's federal guidelines that mandate that we have to stress test you, and that means that even though you might get an interest rate of 1.5%, we have to, as of today, the stress test would be 5.25%. So we run the analysis based on 5.25%, and you have to have debt ratios that fall underneath a certain percentage. And back then there was no stress test, or we could qualify you on the contract rate. We don't have that anymore. So your
Mm.
purchasing power's gone down, the cost of real estate's gone up, and you've been sitting on money that's depreciating. It's not, no, no, no. It's it's just it's been
No,
tough.
no, no.
No,
Wait,
no, no, no,
you
no.
gotta. The thing is, I feel like, and this is when you're not kind of educated in the space. Um, you're not only looking at like stress tests, but one of the biggest things I feel like is um, you have to qualify a certain way, but people always look at rates. They feel like
Right,
rates is the only thing you're supposed to look at. And what I don't understand, I don't know, maybe there's something I'm missing, but when you're going into a professional, let's say I come to you, I'm going to rely on you and your expertise to understand that, okay, if a bank like HSBC is offering a 0.99 fixed rate interest, right, for the next 5 years or whatever it is, 1 year, whatever the term is, that there's
I think it
going to
was
be a
5 years.
catch. There's going
Yeah,
to be a catch. What's that catch?
100%. Yeah. I mean, you got to think about it. A bank, what other business is in it to make money
Yeah.
like a bank? A bank. And you don't get a free lunch, and everything comes at a cost. And sure, sometimes you can get some really enticing promotions that come out there, but they've done it. They've got more money than we do, and they sit down and they do the analysis and they figure out, okay, you know what? How do we make the money back? And 9 out of 10 times on a low rate like that, there are very few opportunities for you to make any change to that that's not going to trigger an insane penalty.
Yeah.
And that penalty is something that, what do they say? Like 65% of Canadians are dealing with a penalty. If they're in a 5-year fixed
Yeah.
or a 5-year term in general, you're going to break it at some point. And in this market, so many people, like I've had 4 emails today with people reaching out to me saying, hey, you did a mortgage in the past. We're looking to access equity. We want to get into the market. And part of that is just watching the news. Anywhere you look, anywhere you read, you watch, people are talking about real estate, and it's the fear of missing out. So if they want to get in and they have property, they probably have a ton of equity that's been built up
Right.
in the last 5 years. You want to access it. Guess what? That HSBC or whatever, not picking on HSBC, but
Yeah.
whatever bank it is, yeah, they're a good lender. But whatever bank it is, you could be in for a very big penalty that's going
Yeah.
to wipe out some of those earnings.
And
So
it's
yeah,
it's it's unbelievable how many times I've seen clients pay out 30,000, 40,000, 50,000 in penalties because they're refinancing because they had to, because they're selling their house, because they needed to move, they found a better job or whatever it is, right? And a part of it,
divorce is a big one,
divorce
especially
is
during
huge.
lockdown.
Yeah.
People realize they can't stand my spouse, so
So they're
yeah,
out, and
it's
then when they're out, they're also not only paying, legal fees and everything, but they're also paying these bank fees. And what I've
yeah,
seen is again, you have to be wise about it. That like, this is it's basically a numbers game. They're looking at how many people are going to have this life event, because that's where
right.
they're making the money. 0.99
Right.
is what's called a loss leader. They may not be making money. They may be losing money. I don't know, but 0.99 or any other interest rate, right? But they're looking at like how many life events are going to happen statistically, and how are we going to then push up our bottom line. I mean, like, banks are always reporting profits nonstop, and it's like, where are they getting that money from? It's not from your like 9.99, whatever the heck you're paying per month for your
Yeah.
bank account, right? That's not how they're getting
Yeah,
rich,
yeah,
right?
yeah,
It's coming from these fees, and I feel like a lot. The other thing is when houses are appreciating this quickly, when you're seeing a bump of 25% for whatever reason, people don't feel like, all right, if I have to pay 40,000 extra, whatever, I still have my original price kind of with me,
yeah,
which is
yeah,
very
yeah, yeah.
foolish, because it's like, now you just gave away your appreciation of the home. And again, you're not looking at it from the perspective of your cash is losing value. Like, even if you bought a house for $500,000, and then after the fees or whatever, breaking out early, you get $500,000 back. That $500,000 is not worth $500,000, because to get a house like the house that you paid $500,000 for, it's going to be more.
Yeah,
So it's
100%. And that's got to be, I think, more of the conversation. And that's what kind of frustrates me sometimes, to be honest, when you get someone that calls you up and, it's kind of like when someone is trying to self-diagnose and they go on Google and then
yeah,
they're like, I'm a doctor. You're not a doctor. You just Googled something and you don't know. It could be a plethora of anything that's ailing you. But same thing, man. People go, and I'm not saying not to do your homework, but when they don't understand, like, for example, you go on a website like, and again, not to knock some of these websites,
yeah,
but these comparison websites, they'll have teaser rates out there, but there isn't a lot of information on what exactly those rates are, who can qualify for those rates, right? So there's insured mortgages, there's insurable mortgages, there's uninsured mortgages, there's conventional insurable mortgages. I've just named four. And then, within it, you've got different types of rates. You have different rates for rental properties versus owner occupied. So what do you think they're going to show you on a website? It's going to be like, cream of the
yeah,
crop, the easy ones, the insured mortgages, 5% down purchase. And if you don't qualify for it, and yeah, people typically, if I haven't talked to them before, the conversation always focuses around rate because it's an easy conversation
yeah.
piece, but it's one that you got to take in. And like you said, what's the worst penalty you've seen come across your desk dollar wise?
Okay. I've seen above 50, but what I did see once, okay, and without revealing, I mean, I'm not going to give specifics about the client, but what I have seen once, as in recently, was somebody bought a house because they wanted to get into the real estate market. Fine. And we're kind of advocating that, but they got into a 5-year fixed, right?
Mm.
Um, financial, their financial circumstances changed. Okay. So whether they lost a job or whatever it is, they couldn't make those payments, because that happens, right?
Mm.
People kind of assume
Mm.
that whatever they
Yeah.
are, they're going to move out to infinity, right?
Yeah.
So this person, this individual tried to take on more debt to try to pay off So now he's kind of taken on private loans that are leveraging up to like 90% of the property, 95% of the property. At that point, person decides that, hey, I can't afford this house, so I'm gonna sell it. They sell it, and then when we go and request a discharge statement, the house could be worth, again, this is a hypothetical number. The scenario is real, but the number is hypothetical. They're selling the house for 700,000, but with the penalty on the discharge and all these other penalties everywhere else, they are owing 740,000. Okay,
Wow.
so everything's wiped out. Everything, their entire equity, their position was wiped out, and they are now panicking because you've sold this property. You're in an agreement which is firm, so you're obliged to sell. However, legal practice is that the other side's law firm, rightfully so, said, hey, listen, discharge statement here states that you are like, this is what your discharge is going to be, and this is what all the liens are on the property. It's more than how much we're selling you. So we need to make sure that you have the funds, the excess funds, the client has them deposited into the law firm's trust account before we give you our money, right? Because typically, like, as lawyers don't, like, when you're selling a home, we don't give you your money and say, hey, go pay the bank off. Like, we have to pay it off ourselves, which is just part of the course, because the buyer side is going to say, you're taking an undertaking, your law firm is going to be responsible to pay this money off, which is what we do. So they're like, no, we're not giving you this, and until we know that you can actually pay for everything. So this person panicked, and there's a lot of stress. There's family involved. There was a lot of other things going on, and then he finally was able to. Here's the other thing. So he was not able to get the money in time, so we had to negotiate an extension in the sale. So there was other fees and penalties that the other side's
that are thrown on because you didn't close on time.
So
now that's a runaway snowball
Yeah.
right there. And I mean, it's one of those things that, it doesn't happen too often, but it's something you need to be so careful of too, is that you don't over leverage yourself, because those fees, those lender fees and other fees that they throw on private money can definitely add up. Wow. Okay. And see, if a client came to me like that, it would looking to purchase, I would probably turn them the other way, just because it's not a position I'd want to put myself in. So it's
I mean,
and it's very stressful.
When they started, that's the thing. When they started, they were in a good position. They got a very low rate from a reputable bank. It was an A lender, right? So everything was good. It looked very nice. The borrower looked nice, whatever. And I wouldn't necessarily say it's completely the borrower's fault, because they tried their best to kind of make it right, all these other things. But sometimes, like, for example, you lose your job, there's no, like, I mean, if the government comes tomorrow and says, all right, I want to, like, close down the business, you're only 6 months you can prolong your mortgage, but after that it stops. Like, you got to figure out some way to pay everything off, and you could be doing the right thing, but life happens. And that's what kind of, I think, a lot of people fail to see, that you need to be, like, kind of aware of, like, the fact that anything can happen. And for example, with a mortgage broker, you're looking at that, and it's kind of your job, I would assume, that saying, like, all right, I kind of know what your position is, what your income is, whatever, right? For you, this may not be the best rate. This may be the best product for you. And kind of place them in the right place, because I know where your income's coming from. If if I know that, for example, you have so many assets, you're going to pay this no matter what, go for the fixed or whatever it is, because you'll be able to hold on to it no matter what happens. But if not, which is the case for most of us, man, unfortunately, people need to look a different way.
I agree 100%. It's you have to take a holistic approach to it when you're looking at their finances. I think that was a pretty good first podcast.
Yeah.
Yeah. Nice talking to you, Harris.
Yeah. Well, you know
Pretty good.
what? Thanks for everybody for tuning in, and
Yeah, guys.
we're hoping to do this often. So if you want more information on real estate, on mortgages, finance, legal, join us, and yeah, we'll be talking
Yeah,
about
and
everything under the sun.
yeah, I'd and the only thing I would add to this is that if you guys do have any suggestions or anything, any topics you want us to cover, just reach out, and we'll do our best to answer. Because I know there's a ton of people out there that have a ton of questions. Because both you and I, Harris, we feel these questions every single
Yeah.
day. So just speak up, and we'll definitely address it. Cool, man. It was good talking to you, Harris.
All right. Later, guys.
Okay, see you. Bye.